Okay, I'll move on from there. Let's talk about the Roarscore. The Roarscore, I'm pleased to say, probably the most popular piece of intellectual property that I've developed. Um, and that might be because it has a lot of pretty colors, or it could just be because most people are trying to target shoot, Uh, they're trying to say, buy this, sell this. Now, look, I love the media folks that I work with. I really enjoy all the work I do with Seeking Alpha. However, I will say this. Remember what I said before, the average stock has kind of gone nowhere in like 4 years. What does that mean for all of those buy recommendations on stocks? Thousands and thousands of them across so many platforms. Well, they haven't really produced anything over an extended period of time. Maybe there were trades, that's different. Okay. But unfortunately, people only look at what they can make and they rarely put as much work into risk management. So, what I did, because I wanted to simplify this, it could technically be anywhere from 0 to 100. But one way I interpret this is, what are the chances that the next major move, and it's all explained here again, that's why we're giving this part away, even the Roarscore history is down here, so you can see that. But the one way I like to think of this is, okay, how confident am I that the next major move in this security is going to be up instead of down? In the same way, you go back to the Roarscores, 20 this week. It's been a 20 for a little while here in September of 2025. Well, that means that I think there's probably a much greater chance, you call it 80%, I don't know if I'd be that precise, but it's in that neighborhood if I had a guesstimate, okay? I'd say 20% chance there's a big rally from here. What's big? 10, 15% versus an equally sized decline is a much greater. And that's why the Roarscore at a 20, I consider the risk taken to pursue return is high. So that can range anywhere from 80, very low, not impossible though, okay? That's why it doesn't go below 10 and it doesn't go above 80, because I just don't think there's any such thing. This is why I don't like buy and sell ratings, because if you have a buy or a sell rating, nobody asks the follow-up question because they can't. What's the follow-up question? Well, okay, you love this stock, you're pounding the table on it. How much of my money should I put in it? It's a personal decision. When I managed other people's money for 27 years and the funds I ran, I was making those decisions because I was a fiduciary and I was charged to do it. That was my job. And we had a mandate, and a strategy that we would need to obey. Same thing with private client, wealth money. So to me, there's no absolutes here. And that's why I refer to these as, and it's based on the chart pattern. So a chart that's in the sweet spot, like the S&P 500, probably was here or here. I'm still with the main Roarscore. You're just hardly ever going to see it in the 60, 70, 80 range. We have two versions of it, by the way, and I'll get to that in a minute. But this is really more at the individual security level, but I wanted to show the S&P over here. So it is based on the charts. It's based on a combination of quantitative inputs. I actually use bar chart data for a lot of that stuff. I've written about there extensively in my column, which is one of the reasons we get along so well, they and I. And but there's all these different classifications, and so I have actually tried to put the chart patterns into words, and I came up with 8 different descriptions. It could be in the sweet spot. It could simply be uptrending. It could be showing signs of getting into that stronger confidence level. It's about, confidence, but not just confidence based on, cockiness, confidence based on, a process. Same process I've developed for a long time. It could be undecided. A lot of stuff can end up in here for a little while. It's kind of like, hey, no sudden moves. That's what I tell myself all the time. It could be stretched. Right now, the market is arguably very stretched, okay? But as risk manager, I still put it down here. If I were a more aggressive investor or a moderate risk investor, it might be a little bit higher. Once it's stretched, one of two things can happen. It can either go back in toward uptrend, or it can be fading or rolling. And that's when you get these happening, okay? Like you see here with these arrows. I'm waiting on this right now on a weekly chart basis anyway. Daily chart is even less convincing one way or the other. And then once you get into this, okay, your estimated risk taken to pursue return is getting very high. It can get higher, and it can get very high. And then the cycle starts all over again. The mistake a lot of people are making, and I mentioned this in the ConAgra example before, the mistake I see people making is that as soon as the stock is down a little bit, or an ETF, sector, what have you, everybody rushes in and say, that's it, buy the dip, buy the dip. Well, there's a difference, okay? That's not a dip to buy. A dip to buy is something that would say showing signs, okay? And by the way, why do I say showing signs? It's kind of not a common thing. My dad was a big Marv Albert fan, broadcaster back then for the Knicks and the Rangers, and for football games. And I won't do the Marv Albert impersonation here, but that's what he would say when a slumping player in a game was coming out of coming out of the funk. You know, so if he was slow in the first couple of quarters, all of a sudden he's made a couple of baskets in a row. You know, Marv would say showing signs. Okay, so that's to me the equivalent. That's all right here.